ESG investing is a way of making your money work with the environmental, social and governance priorities that matter to you, whether that's action on climate or gender equality and diversity in the workplace. Global inflows to ESG funds peaked in 2021 at $645 billion, but that was back when the Biden administration was encouraging investors to put their money into clean energy in particular, with massive subsidies and tax breaks. Things have changed since then.
Climate change. It's the greatest con job ever perpetrated on the world, in my opinion.
The Trump administration has gutted support for clean energy, calling major investments into question.
There have been various different estimates on the impact of the scrapping of the previous policies and the sort of pivot towards fossil fuels, basically. And one group at Princeton University estimated that about $600 billion less money will be invested from now through 2035 in the renewable space.
Under President Trump, the US government is also putting political pressure on fund managers. In the first week of his new administration, Trump issued executive orders threatening private firms with legal action if they run diversity and equity programs. That means some ESG funds could be in legal trouble in the US.
The research has shown that companies that embrace DEI are more innovative, they're more profitable, and they're more successful when compared to their peers who are not embracing DEI. So I think that in the end, it's going to hurt businesses rather than help them.
So if anything, those corporates that feel strongly about their diversity policies will essentially double then their commitment, redouble their commitments to having these policies in place and investing with a sustainability lens.
The changing environment is making investors and money managers nervous, though. According to data from Morningstar, a record $11.8 billion was withdrawn from ESG funds in the first 3 months of 2025, and at least 335 funds rebranded by changing or dropping their environmental, social and governance terms.
It is actually quite refreshing because some have been celebrating the fact that some of the gestures or the policies in place or some of the wording used, the materials used were performative in the past, that there was actually not a need to bring these things to the front of the presentation, that they were integrated across the entire investment process, always have been.
There's certainly a lot of dressing up what used to be clean energy. Now they're calling themselves energy security types of investments. And they're really trying to focus on adding to the energy supply and electricity and solving America's energy shortage problems. And they're kind of glossing over how they're doing that.
There is an element of paying attention to the zeitgeist. If you have sustainability all over your products, and maybe some of that was performative and paying lip service, now you may recognize that that is no longer an asset, but is in effect a liability. And you may desire to reframe that, but not change much of what you're doing behind the scenes.
But regardless of whether investments are called ESG or not, the economic case for clean energy is building. America and the world need a lot more power. Data centres alone are forecast to eat up 12% of all US electricity consumption by 2030. The switch to electric cars and soaring air conditioning use as temperatures rise are also driving demand.
It's been decades since we've seen electricity demand growth expand at this pace. So there's really nobody around who has kind of invested in and operated in this type of environment before. And everybody needs more electricity immediately. They can't really afford to wait 5-10 years down the road.
Electricity and its pricing is starting to form an increasingly large part of the inflation picture, and that's a concern. We know that social concerns around electricity pricing and demand is affecting whether licenses are given to data centres to locate in certain high population places. So this is really starting to affect the competitiveness of certain regions and their readiness for AI and its transformative appeal.
Renewables are very hard to beat, particularly solar. You can scale them up very quickly and they can start generating electricity tomorrow in many cases. They are still by far the fastest and marginally the cheapest way to generate power.
That means money is flowing back into sustainable funds. In the US, their assets have rebounded to match the peak back in 2021.
Where the business case stands up and where investors can get visibility as to that, there is going to be strong demand. We've just come off the back of COP in Brazil, We know that there were certain players present there, certain not present, and that there was some disappointment around watering down of some of the prior commitments. What I would say, though, is that there is an awareness of this shortage of electricity provision around the world and an increase in demand. We need to square that circle. 2025 was probably the worst year in terms of headwinds and resetting. This is the year of the reset, and 2026 back to business as usual.